What if I told you that the window to exchange your paper dollars for real, tangible assets is closing faster than most people realize? Not in some distant future, not when the headlines finally catch up, but right now, while most Americans are still asleep at the wheel, trusting a system that's been quietly dismantling itself for decades. You see, there's something happening in the precious metals markets that defies everything we've been taught about how money works. Gold has been climbing to levels that would have seemed impossible just a few years ago, and silver is following right behind it. But here's what nobody's talking about. This isn't just a bull market. This is a fundamental restructuring of the global monetary system. And the people who understand what's really happening are moving their wealth out of paper and into hard assets at a pace we haven't seen since the 1970s. Let me paint you a picture of what's actually going on behind the scenes. While the mainstream financial media keeps telling you that everything's fine, that the dollar is strong, that inflation is under control, there's a completely different story playing out in the vaults of central banks around the world. These institutions, the ones that literally control the money supply of entire nations, have been buying physical gold at a rate that should terrify anyone paying attention. We're not talking about modest portfolio adjustments here. We're talking about hundreds of tons of gold being pulled out of the market and locked away in sovereign vaults month after month with no signs of slowing down. Think about that for a second. The very institutions that print money, that control interest rates, that tell us paper currency is perfectly safe, are frantically converting that same paper into gold. Why? Because they know something that most retail investors don't. They understand that the current monetary system is built on a foundation of debt that can never be repaid, and they're positioning themselves for what comes next. Now, I want you to imagine you're sitting in a meeting room in Beijing, or Moscow, or New Delhi. You're looking at your country's foreign reserves, and you see billions upon billions of dollars in U.S. Treasury bonds. You know that the United States has been running trillion-dollar deficits year after year. You know that the Federal Reserve has expanded its balance sheet to levels that would have been considered insane just a generation ago. You know that the dollar's purchasing power has been eroding steadily, and you know that the geopolitical landscape is shifting in ways that make dollar dominance less certain with each passing year. What do? You do exactly what these central banks have been doing. You quietly, methodically, start converting those paper assets into something that can't be printed, can't be devalued by a keystroke, and has held value for thousands of years. You buy gold, and you don't just buy a little bit. You buy as much as you can without causing a panic in the markets. The numbers tell a story that's almost hard to believe. Central banks have been net buyers of gold for over a decade now, but the pace has accelerated dramatically in recent years. BRICS nations alone have been accumulating gold at a rate that suggests they're preparing for a major shift in the global monetary order. We're talking about hundreds of metric tons being purchased in just the first 3 quarters of recent periods. That's not portfolio diversification. That's preparation. Before we go any further, I want to make sure you have access to something that could be crucial for your financial future. I've put together a comprehensive guide that breaks down the exact strategies thousands of American retirees are using right now to protect their hard-earned wealth from what's coming. It's completely free, and you'll find the link in the description below. This isn't some generic financial advice. This is specific, actionable information about how to position yourself before this window closes. Grab it now, because what I'm about to show you next is going to make it very clear why time is running out. Let's talk about what's happening with silver, because this is where things get really interesting. Silver has always been gold's little brother, the more volatile, more industrial cousin that tends to amplify gold's moves. But what's happening in the silver market right now is something different. We're seeing a supply deficit that's been building for years, industrial demand that's skyrocketing thanks to the green energy transition and technological advancement, and investment demand that's starting to wake up to the fact that silver might be the most undervalued asset in the entire precious metals complex. Here's what most people don't understand about silver. Unlike gold, which is primarily a monetary metal and a store of value, silver is consumed. It's used in solar panels, in electric vehicles, in electronics, in medical applications, in water purification. Every year, billions of ounces of silver are used in industrial applications and never recovered. They're gone forever. Meanwhile, above-ground silver inventories have been declining, mining production has been relatively flat, and the amount of silver available for investment has been shrinking. Now layer on top of that the fact that silver has historically traded at a ratio to gold that's much lower than where we are today. Throughout history, the gold to silver ratio has averaged somewhere in the range of 15 to 1, meaning it took 15 ounces of silver to buy 1 ounce of gold. There have been periods where it's been as low as 10 to 1. But in recent years, we've seen that ratio spike to levels that are historically extreme, sometimes approaching 100 to 1 or even higher. What does that tell you? It tells you that silver is either dramatically undervalued relative to gold, or gold is dramatically overvalued relative to silver. And given what we know about central bank buying and the monetary system, which do you think is more likely? Let me tell you a story about what happened the last time we saw a major monetary reset. In 1971, President Nixon closed the gold window, ending the Bretton Woods system and severing the last official link between the dollar and gold. At the time, gold was trading at $35 an ounce. That was the official price, the price at which foreign central banks could theoretically exchange their dollars for gold. Within a decade, gold had risen to over $800 an ounce. That's not a typo, a more than 20-fold increase in less than 10 years. But here's what's even more interesting. Silver went from around $1.50 an ounce to a peak of over $50 an ounce in 1980. That's a 30-fold increase. Why did silver outperform gold? Because once the monetary reset began, once people realized that the old system was gone and a new one was emerging, they piled into the most undervalued monetary metal they could find, and that was silver. Now, I'm not saying history is going to repeat itself exactly. Markets never do. But I am saying that the parallels between what happened in the 1970s and what's happening right now are striking. We have a monetary system that's clearly under stress. We have central banks that are losing control of inflation. We have geopolitical tensions that are fracturing the post-World War II order. We have debt levels that are unsustainable. And we have precious metals that are starting to price in a future that looks very different from the past. Let's talk about the mechanics of what's actually happening in these markets, because this is where you start to see just how fragile the whole system really is. The gold and silver markets operate on two levels. There's the physical market, where actual metal changes hands, and there's the paper market, where contracts representing gold and silver are traded on exchanges like the COMEX. The paper market is massive, orders of magnitude larger than the physical market. For every ounce of physical gold that exists, there are dozens, maybe hundreds of paper claims on that gold. This works fine as long as everyone's playing the same game, as long as most people are content to own paper promises instead of physical metal. But what happens when that changes? What happens when a significant number of people decide they want to convert their paper claims into physical metal? You get what's called a squeeze. And we've been seeing signs of stress in these markets that suggest a squeeze might be building. Look at what's been happening with COMEX inventories. The amount of gold and silver sitting in COMEX warehouses, available for delivery, has been fluctuating in ways that suggest there's real demand for physical metal. We've seen periods where registered gold, the gold that's actually available for delivery against futures contracts, has dropped to levels that are alarmingly low relative to the open interest in those contracts. That's a red flag. It means that if even a small percentage of contract holders decided they wanted physical delivery instead of cash settlement, the exchange might not have enough metal to meet that demand. And it's not just the COMEX. Look at what's happening with sovereign gold. Countries are repatriating their gold, bringing it home from vaults in London and New York. Germany did it. Austria did it. The Netherlands did it. Why? Because they want to make sure that if something goes wrong with the global financial system, they have physical possession of their gold. They don't want to be holding a claim on gold that's sitting in someone else's vault. They want the real thing in their own vault, under their own control. This is the behavior of institutions that are preparing for a scenario where counterparty risk becomes a real issue, where the paper promises that underpin the current system might not be honored. And if sovereign nations are thinking this way, shouldn't you be thinking this way too? Now, let's talk about what's driving this from a fundamental perspective, because it's not just about monetary policy and central bank buying. There are real supply and demand dynamics at play here that are pushing these markets in ways that are hard to ignore. On the supply side, gold and silver mining is not easy. It's expensive, it's time-consuming, and it's getting harder. The easy deposits have been found and mined. The ore grades are declining. The costs are rising. And the time it takes to bring a new mine online, from discovery to production, can be a decade or more. Meanwhile, demand is increasing. We've already talked about central bank demand for gold, but there's also retail demand, institutional demand, and in the case of silver, industrial demand that's being driven by technological trends that aren't going away. The transition to renewable energy requires massive amounts of silver. Every solar panel uses silver. Every electric vehicle uses significantly more silver than a traditional car. The build-out of 5G networks, the expansion of electronics manufacturing, the growth of medical applications, all of this requires silver. And unlike gold, which can be recycled relatively easily, much of the silver used in industrial applications is consumed and lost. So you have a situation where supply is constrained and demand is growing, and that's before you even factor in investment demand. What happens when investors start to wake up to the fact that silver might be one of the most asymmetric bets available in the entire market? What happens when the ratio of gold to silver starts to revert to historical norms? What happens when people realize that silver is not just an industrial metal, but a monetary metal that's been suppressed for decades? Let me give you another historical parallel, because this is important. In 2008, during the financial crisis, gold and silver both sold off initially as part of the broader market panic. People needed cash, so they sold everything, including precious metals. But then something interesting happened. As central banks around the world responded to the crisis by slashing interest rates and implementing quantitative easing, as governments ran massive deficits to stimulate their economies, gold and silver began a rally that would last for years. Gold went from around $700 an ounce in late 2008 to over $1,900 an ounce by 2011. Silver went from around $9 an ounce to nearly $50 an ounce in the same period. Why? Because people realized that the response to the crisis was going to be monetary expansion on a scale never seen before. And they wanted to own assets that couldn't be printed. They wanted to own things that would hold their value when paper currencies were being debased. And they were right. Now here's the thing. The monetary expansion that happened after 2008 was just the beginning. The response to the pandemic dwarfed what happened after the financial crisis. The amount of money that was created, the size of the deficits that were run, the expansion of central bank balance sheets, all of it was orders of magnitude larger than what we saw in 2008. And yet somehow we're supposed to believe that this won't have consequences, that we can just print trillions of dollars and everything will be fine. The central banks know better. That's why they're buying gold. The sovereign wealth funds know better. That's why they're buying gold. The ultra-wealthy know better. That's why they're buying gold and silver. The question is, do you know better? And more importantly, are you going to act on that knowledge before it's too late? Here's where this gets personal, and I want to be very direct with you about something. If you're sitting on a retirement account with $100,000 or more, you need to understand that you have options that most people don't even know exist. You can move a portion of that money into physical gold and silver held in your name inside a tax-advantaged retirement account. It's called a gold IRA, and it's one of the most powerful tools available for protecting your wealth from the kind of monetary chaos we're heading into. I've put together a detailed guide that walks you through exactly how this works, how to set it up, what the rules are, and how to do it without triggering any tax penalties. It's in the description below, and if you have significant retirement savings that you're worried about, this is information you need to have. Because here's the reality. When the next crisis hits, when the dollar's purchasing power takes another leg down, when inflation comes roaring back, or when we see a currency reset that makes the 1971 Nixon shock look tame by comparison, it's going to be too late to protect yourself. The time to act is now, while you still can, while physical metal is still available, while the premiums are still reasonable, and while the system is still functioning normally. Now, let's talk about what's happening with the dollar itself, because this is the elephant in the room that nobody wants to acknowledge. The US dollar has been the world's reserve currency since the end of World War II. That status has given the United States enormous privileges. It's allowed us to run deficits that would bankrupt any other country. It's allowed us to export our inflation to the rest of the world. It's allowed us to maintain a standard of living that's built on debt rather than production. But that status is not guaranteed. It's not a law of nature. It's a function of trust, of economic power, of military might, and of the willingness of other countries to continue playing along. And increasingly, other countries are not willing to play along. The BRICS nations, Brazil, Russia, India, China, and South Africa, along with a growing list of other countries, have been working on alternatives to the dollar-based system. They've been setting up currency swap agreements that bypass the dollar. They've been trading oil and other commodities in their own currencies. They've been building payment systems that don't rely on SWIFT, the Western-controlled messaging system that underpins international finance. And most importantly, they've been buying gold. This is not a conspiracy theory. This is not speculation. This is documented fact. These countries have explicitly stated that they want to reduce their dependence on the dollar, and they're taking concrete steps to do it. Now, does that mean the dollar is going to collapse tomorrow? No. The dollar is still the dominant reserve currency, and it's going to take time for that to change. But the direction of travel is clear, and the implications for anyone holding dollar-denominated assets are profound. Think about what it means if the dollar loses even a portion of its reserve currency status. It means that all those dollars that are currently held overseas, in central bank reserves, in sovereign wealth funds, in corporate treasuries, start coming home. It means that the demand for dollars decreases and the supply increases. It means that the value of the dollar falls and the price of everything denominated in dollars, including gold and silver, rises. It means that the purchasing power of your savings, your retirement account, your cash, all of it erodes. This is not some distant theoretical risk. This is happening right now in slow motion, and the people who are paying attention are positioning themselves accordingly. They're moving out of paper assets and into hard assets. They're buying real estate, they're buying commodities, they're buying businesses, and they're buying precious metals because they understand that in a world where currencies are being debased and the monetary system is being restructured, the only safe haven is something that has intrinsic value, something that can't be printed, something that has been recognized as money for thousands of years. Let's talk about the technical picture for a moment, because even if you're not a chart person, there are some things happening in the gold and silver markets that are worth paying attention to. Gold has been in a long-term uptrend, making higher highs and higher lows, breaking through resistance levels that held for years. This is not a speculative bubble driven by retail enthusiasm. This is a steady, methodical accumulation by institutions that understand value. The kind of buying that happens when smart money is positioning for a major move. Silver has been more volatile, as it always is, but the pattern is similar. We've seen silver break through key resistance levels, pull back, consolidate, and then push higher again. The volatility is actually a feature, not a bug, because it creates opportunities for those who understand the bigger picture. When silver pulls back, it's not a sign that the thesis is broken. It's an opportunity to add to positions at better prices. And here's something that should really get your attention. The ratio of gold to silver, which I mentioned earlier, has been compressing. That means silver has been outperforming gold on a relative basis. And if history is any guide, when silver starts to outperform gold, it's often a sign that we're in the early stages of a major precious metals bull market, because silver is the more speculative, more volatile metal, and it tends to attract momentum when the trend is clearly established. Now, I want to address something that I know some of you are thinking. You're thinking, but what if I'm wrong? What if the dollar doesn't collapse? What if the monetary system doesn't reset? What if gold and silver go down instead of up? And those are fair questions. Nobody has a crystal ball. Nobody can predict the future with certainty. But here's what I would say to that. First, this is not about predicting a specific outcome on a specific timeline. This is about understanding risk and positioning yourself accordingly. Even if the dollar doesn't collapse, even if the monetary system muddles through, gold and silver have proven themselves over thousands of years as stores of value. They've survived every empire, every currency, every financial crisis. They're insurance, and insurance is valuable even if you never have to use it. Second, the downside risk of owning physical gold and silver is limited. Yes, the price can go down, but gold and silver are never going to zero. They're never going to become worthless. Can you say the same thing about a dollar? Can you say the same thing about a bond? Can you say the same thing about a stock? Physical precious metals have no counterparty risk. They don't depend on anyone else's promise. They don't depend on a company's earnings or a government's solvency. They just are. Third, and this is crucial, the asymmetry of the bet is heavily in your favor. If you're right, if we do see a monetary reset, if the dollar does lose significant value, if gold and silver do what they did in the 1970s, the upside is enormous. We're talking about potential multiples of your initial investment. But if you're wrong, if none of that happens, you still own a tangible asset that has held value for millennia. You haven't lost everything. You've just held a different form of savings. Compare that to the alternative. If you keep all your wealth in paper assets, in dollars, in bonds, in stocks, and the monetary system does reset, what happens? You could lose a significant portion of your purchasing power, maybe even most of it. The asymmetry there is terrible. You're risking a lot for relatively modest potential gains. Let me tell you about something that happened in Weimar, Germany, because this is a story that everyone should know, but most people have forgotten. In the early 1920s, Germany was dealing with the aftermath of World War I, massive war reparations, and a government that decided to print money to pay its debts. At first, the inflation was manageable. Prices went up, but not catastrophically. People adjusted. They thought it would pass, but then it accelerated. Prices started doubling every few days, then every few hours. People would rush to spend their money as soon as they got it, because by the next day, it would be worth half as much. Workers demanded to be paid twice a day so they could buy things before the money lost its value. People used wheelbarrows full of cash to buy a loaf of bread. The currency became so worthless that people used it as wallpaper, as kindling for fires, because it was cheaper than buying actual wallpaper or firewood. And here's the thing that's really important. The people who were destroyed by this were the people who trusted the system, who kept their savings in the bank, who held bonds, who believed that the government would fix things. The people who survived, who even thrived, were the people who got out of paper and into hard assets. They bought real estate, they bought businesses, they bought gold and silver. They understood that when a currency is being destroyed, the only rational response is to get out of that currency and into something real. Now, am I saying that the United States is going to experience Weimar-style hyperinflation? No. The US economy is much larger, much more diverse, and the dollar's reserve currency status provides a buffer that Weimar Germany didn't have. But am I saying that the principles are the same, that the risks are real, that the people who ignore history are doomed to repeat it? Absolutely. We're living through a period of monetary experimentation that has no precedent in modern history. The amount of debt, the size of central bank balance sheets, the scale of government deficits, all of it is unprecedented. And the people who are running this experiment, the central bankers and the politicians, they don't know how it's going to end any more than you or I do. They're making it up as they go along, hoping that they can manage the unmanageable, that they can control the uncontrollable. But here's what we know from history. Every time a government has tried to print its way out of a debt crisis, it has ended badly. Every time a currency has been debased beyond a certain point, it has lost value. Every time a monetary system has been built on unsustainable foundations, it has eventually collapsed. The details are different each time, the timeline is different, the specific mechanisms are different, but the outcome is always the same. Paper loses value, hard assets hold value, and that brings us to the question that you need to ask yourself right now. What are you going to do with this information? Are you going to ignore it, hope that everything works out, trust that the people in charge know what they're doing? Or are you going to take action, protect yourself, position your wealth in a way that gives you the best chance of not just surviving, but thriving in whatever comes next? Because here's the reality. The window for action is closing, not because I say so, but because the market is telling us. Gold is at or near all-time highs. Silver is climbing. Central banks are buying at record pace. The signs are everywhere if you're willing to look. And once the crowd figures this out, once the mainstream catches on, it's going to be too late. The premiums on physical metal are going to skyrocket. The availability is going to dry up. The prices are going to gap higher in ways that make it impossible to get in at reasonable levels.